When Raoul Pal speaks about the future, investors tend to pay attention. Not because he claims to predict the future, but because he has spent decades studying the forces that shape it. Before becoming one of the most recognized macro investors in the world, Raoul Pal worked at Goldman Sachs and later managed hedge fund capital, focusing on global markets, economic cycles, and technological change. Over the years, Raoul Pal built a reputation for identifying major trends long before they became mainstream conversations. While many investors were focused on short-term market moves, Raoul Pal was studying the bigger picture: how technology, demographics, liquidity, and innovation reshape entire economies. In recent years, one theme has stood above all others: crypto. But not for the reasons most people think. While headlines focus on price volatility and speculation, Raoul Pal believes something much bigger is happening beneath the surface. He argues that we're witnessing the creation of a new digital infrastructure layer for the global economy. An infrastructure layer that could eventually support artificial intelligence, global finance, digital ownership, payments, and entirely new forms of economic activity. And according to Raoul Pal, the majority of investors still don't understand where the real value may ultimately accrue. Because history has a funny way of repeating itself. The biggest fortunes are rarely made by owning the products everyone talks about. They're often made by owning the infrastructure that makes those products possible. Which raises a fascinating question. If blockchain networks become the foundation of the next digital era, which networks will capture the most value? And why does Raoul Pal believe the answer may already be hiding in plain sight? What if the biggest investment opportunity of the next decade isn't Bitcoin? What if the real winners are the invisible networks underneath everything? What if the biggest investment opportunity of the next decade isn't Bitcoin? What if the real winners are the invisible networks underneath everything? The networks that most people barely understand. The networks that could power artificial intelligence, global finance, digital identity, ownership, payments, gaming, and entire economies. Most people look at crypto and see coins. But what if they're looking at it completely wrong? Because history shows that the greatest fortunes are rarely made by investing in the applications. They're made by owning the infrastructure. The railroads built fortunes during industrialization. The internet created trillion-dollar technology giants. And now, a new form of digital infrastructure is emerging. The question is simple. If this new system becomes the foundation of the future economy, which networks will own that future? And why do some investors believe the answer is already becoming obvious? There's a saying in investing: in hindsight, it was obvious. People say it after they miss the biggest opportunities. After they ignore a trend. After they watch others become wealthy while they sit on the sidelines. The internet was obvious in hindsight. Smartphones were obvious in hindsight. Artificial intelligence may eventually seem obvious too. But what if some opportunities are actually obvious before they happen? What if the clues are already visible today? A growing group of investors believes we're witnessing one of those moments right now. Not in meme coins. Not in speculative tokens. But in a handful of blockchain networks known as Layer 1s. The question is why? Why are some of the smartest investors in the world focusing on these networks? And why do they believe a small number of Layer 1 blockchains could become some of the most valuable assets on Earth? To answer that, we need to understand what these networks actually are. And why they may be far more important than most people realize. For years, the crypto market has been viewed through the lens of individual coins. Bitcoin, Ethereum, Solana, thousands of others. Most investors treat them like stocks. Something to buy and hopefully sell at a higher price later. But underneath the price charts lies something much bigger. A global digital infrastructure network. The internet gave the world information. Blockchain gives the world ownership. For the first time in history, people can participate directly in the infrastructure layer of a global digital economy. That changes everything. Think about the companies that dominated previous technological revolutions. Microsoft built operating systems. Amazon built cloud infrastructure. Google built the information layer of the internet. These weren't simply products. They were platforms. Everything else was built on top of them. The same process appears to be happening again. Only this time, the infrastructure is decentralized. And anyone can own a piece of it. But here's where things get interesting. History suggests infrastructure markets rarely have dozens of winners. They usually have only a few. A handful of dominant networks capture most of the value. The rest fight over what's left. If blockchain follows the same pattern, the future may belong to only a small number of Layer 1 networks. And that's where the story starts to get fascinating. To understand the value of a Layer 1 blockchain, imagine pulling the plug on it. Not just stopping trading. Actually, removing the entire network from existence. What disappears? Take Ethereum. If Ethereum vanished tomorrow, what would happen? Thousands of applications would stop functioning. Billions of dollars in digital assets would become inaccessible. Entire financial ecosystems would disappear. NFT marketplaces. Decentralized exchanges. Tokenized assets. Smart contracts. All gone. The economic value destroyed would be enormous. And that's the key insight. The value of a Layer 1 isn't just the token. It's everything built on top of it. The network itself becomes a digital economy. The more activity, applications, users, and capital flowing through the network, the more important that infrastructure becomes. This is similar to how the internet became valuable. Not because of the cables, but because of everything connected to them. As more industries move on-chain, Layer 1 networks begin collecting something incredibly valuable. Economic density. And economic density tends to attract even more activity, creating a powerful feedback loop. But that's only the first layer of the story. Because another force may be driving value even faster. A force connected to artificial intelligence itself. Most people think AI and blockchain are separate trends. One is intelligence. The other is money. But what if they're actually connected? Some investors believe both technologies are part of the same long-term evolution. An evolution that has been happening throughout history. Every major technological breakthrough allows humanity to convert energy into greater intelligence. The steam engine increased productivity. Computers accelerated information processing. The internet connected knowledge globally. Artificial intelligence automates cognitive work. Each step creates more intelligence output from the same amount of energy. And according to this theory, blockchain networks are no different. They're intelligence networks. Machines coordinating value, information, ownership, and computation at a global scale. The networks that produce the greatest intelligence output may ultimately attract the most economic activity. And that creates a completely different way to evaluate blockchain networks. Instead of asking how much revenue they generate today, you ask a different question. How much intelligence can they create tomorrow? That shift changes everything. Because the winners may not be the networks earning the most fees. The winners may be the networks enabling the most innovation. And that leads us directly into the biggest idea of all. Traditionally, investors value assets using cash flow, revenue, profits, earnings. But blockchain networks don't always behave like traditional companies. Their goal isn't necessarily to maximize fees. Their goal is often to reduce friction, to become faster, cheaper, more efficient. Think about it. If a blockchain becomes incredibly useful, transactions should become easier and less expensive. The network succeeds by lowering costs, not raising them. This creates a problem for traditional valuation models. They miss what actually matters: utility, speed, scalability, developer activity, economic density, programmability. These factors may determine which networks dominate the future. Ethereum remains powerful because of its massive developer ecosystem, security, and network effects. It has become the foundation for countless applications. Solana has gained attention because of speed, low costs, and growing adoption. Meanwhile, newer networks are attempting to solve problems even faster and more efficiently. Each network competes to become the infrastructure layer of the digital economy. And infrastructure markets tend to be winner-take-most, not winner-take-all. History suggests there may be room for several dominant networks. Perhaps 3. Perhaps 4. Perhaps 5. Just as cloud computing created multiple giants. Just as mobile operating systems created a few dominant platforms. The future blockchain economy may be built on a small group of foundational networks. As artificial intelligence expands, these networks could become even more important. AI agents will need places to transact, store value, verify ownership, execute agreements, transfer assets, coordinate economic activity. The infrastructure supporting those actions could become extraordinarily valuable. And that's why some investors view Layer 1 networks as the digital railroads of the AI era. Not because of what they are today, but because of what they may become. Of course, no investment thesis is guaranteed. History is filled with technologies that looked unstoppable before collapsing. The internet created enormous wealth, but thousands of internet companies disappeared. Competition remains fierce. Technology changes rapidly. Regulation could impact adoption. Security failures could damage trust. New innovations could make today's leaders obsolete. Even dominant networks face challenges. Ethereum continues working to improve scalability. Solana faces ongoing competition. Emerging networks must prove they can sustain long-term growth. And there's another risk: the assumption that blockchain adoption becomes as widespread as many investors expect. That future is not guaranteed. Markets can stay irrational longer than investors anticipate. Timelines can stretch. Cycles can be brutal. Even revolutionary technologies often experience multiple crashes before achieving mainstream success. That's why conviction and patience become critical. The future may arrive, but rarely on the schedule investors expect. Imagine looking back 10 years from now. Imagine a world where artificial intelligence handles much of the world's digital work. A world where ownership, payments, finance, identity, and commerce operate through decentralized infrastructure. A world where billions of people interact with blockchain technology without even realizing it. If that future emerges, the value may not accrue primarily to the applications. It may flow to the networks underneath them. The invisible infrastructure powering everything. And that's what makes this moment so fascinating. Because the biggest opportunities rarely look obvious when they're happening. They only become obvious later. The internet looked risky before it looked inevitable. Artificial intelligence looked experimental before it looked transformational. The same may eventually be true for blockchain infrastructure. The real question isn't whether people will say, in hindsight, it was obvious. The real question is whether they'll be saying it because they recognized the opportunity. Or because they missed it.